Hi guys, so as you can see, we're currently on the EURUSD weekly chart. I would have gone over in previous videos about which confidences that I use when I'm breaking down a pair, especially from a higher time frame. I would have gone over things such as trendline application, which moving average we use, how to use those moving averages, the fact that we need a minimum of 2 touches to create a trend line, and we need a minimum of 2 touches, for example, to create a range. And I would have gone over the Fibonacci rules, such as the importance of the 78.6, why we would be looking for price to come to the certain Fibonacci percentage and why it will come to that percentage. And I think we would have gone over quite a lot of the rules behind each of those tools. So I think the best place to start now is to almost break down a chart from scratch, as if we're looking at from a higher time frame basis. So the first thing we want to do is we want to look at relevant price, which is this, if I just highlight this zone, we want to look at basically this part of price. So let me just sort the transparency out for this. And we want to focus on really just this part, because this part here is almost irrelevant to some extent. Although we're going to use this to plot some key levels, really what we're focused on right now is this. So the first thing we want to do is decide whether we are bullish or whether we're bearish on this current chart. It's very important that we distinguish which one we are from a higher time frame basis, because when we begin to scale down on the daily, the 4 hour, the 1 hour, and especially the 15 minute, there's a lot of noise, and it's almost like sometimes we can think that we're bullish when we've decided on a higher time frame that we're bearish. But in fact, actually what we're seeing is bullish price action, which is almost like a retracement. So we can't get tricked into that when we've already made our mind up on what we are. So on this particular time frame, I would say that we're bearish. So therefore, I'm only looking for reasons to sell this. Now, the reason why I would say that we're bearish is basically we had this huge up move here, and we broke this. So what really should have happened here, if we were to remain in bullish territory, was we should have come down like we did. We should have retested this trend line and obviously then created a new higher high. But unfortunately, we failed to create that higher high. And we actually broke this trend line. And our most recent higher low was here. So the moment we made this new lower low, like in this kind of region here, that was when we confirmed that in fact we were now bearish. Now a lot of people would think that because we've had this up move and we haven't actually taken out this, that this is almost like a retracement to go higher. But we can't focus too far back. We're only really using this price action to plot our relevant key levels. So we need to really just focus on what's happened almost since sort of the beginning of 2018. Anywhere sort of before that is almost irrelevant unless we're using it to plot key levels. Now, the first thing I'd like to go over first, and I know I probably would have covered this in a previous video, is how to trade a range. Now, it's very important that we know how to trade a range, because 70% of the time we are ranging or consolidating, and it's really only 30% of the time that we're actually creating higher lows and higher highs, and we're trending either bullish or bearish. So if I just do an example here, so say for example price comes up like this, and then price retraces, we basically need a minimum of 2 touches both sides to confirm that we are in fact ranging. So this would be now a confirmed range. We have to have 1 and 2, 1 and 2. Now, when we create this, we can simply box this off or apply a support and resistance. Now, what we are now anticipating is for price to bounce here and come up and create this third touch. Now, as we've gone over in previous videos, the third touch is the touch that we execute from. It's got 80% chance of probability of continuation. So therefore, we're only ever interested in this third touch. So we need 1 and 2 to create 3. We're never interested in trading off 1 and 2. We're only interested in trading off 3. So therefore, when we get our third touch, this would be where we would be placing ourselves, and we'd simply be targeting the bottom of the range. And again, we've now created the third touch at the bottom, so therefore we'd be buying off this level. So 3 and 3. And what's going to basically happen is we're going to continue to trade within this range until we get a breakout. Now, once we start getting to the 4th touch, this is where our probabilities of a trade half. So it's a 50-50 chance that we're either going to break out of this range or we're going to continue to come back down and retest this support. So generally speaking, we don't tend to trade the fourth touch just because our chances are much lower in comparison to a third touch. So like I said, there's three ways to trade this. We can either simply wait for the third touch and sell it, and wait for the third touch and buy it, or the alternative is we can buy it the moment it breaks out, or for example sell it the moment it breaks out. So in this case we would buy it the moment it breaks out of the range, or alternatively we can buy it once it retests. Now my theory is that we should always wait for the retest. On higher time frames sometimes it's difficult to see if we retested or not, and that's when we have to watch price the moment it begins to break out and almost scale down on the 1 hour, the 15 minute to see if we have indeed rejected and retested this. And then what we would have to wait for is some kind of candlestick formation to suggest that indeed this has been respected. Otherwise, it's not it's not a guaranteed retest for us. So that's the three ways that we can trade a range. Now, with regards to range profits, once we do break out, either way, so either if we break out this side or this side, we would simply duplicate the range like this, or duplicate it the other way to get our first targets. Okay, so just to recap on that, we're waiting for a minimum of 2 touches both sides to actually confirm we're actually in a range to begin with. Once we're in a range, we're looking for the third touch of execution, either top or bottom, and then once the range breaks out, our first target is always going to be the duplication of the range. Okay, so that is how we trade ranges. Ranges happen very often, such as this could be classed as a range here. We could trade within this range until it finally breaks out. Now, the problem is with the range is that eventually we're going to get it wrong. What's going to eventually happen is that it's going to come up for this fourth touch, like this, and we're going to go to sell it, and it's going to break out. So it was, at worst case scenario, it's just going to hit our stop losses. But as long as our stop losses are tight and just above the range, then as long as we're making money off the third touches both sides, this fourth touch, the stop loss that we're going to get taken out on isn't going to be as big as our wins on the third touch. So that's how we trade a range. Now, if I just remove this for a second. Now, the reason why I explain this is because there was a specific reason as to why price came up as high as here and then stopped. And we would have actually known this years before. Now, because this is a weekly time frame, we were basically ranging from sort of the 9th of March 2015 until the beginning of 2017. So it's almost 2 years we were ranging for within this zone. Now, when we broke out, I could have even predicted the price was going to go exactly here, just based on the principles of what I've just shown you on how to trade a range. Now, what a lot of people would have done when, let's just do a bar replay. What a lot of people would have done when this broke out is they would have started to look left to see where there was any kind of forms of previous support resistance. So they would have probably, for example, plotted a line here. They would have plotted, say, a line here. And they would have started plotting all these kind of lines to suggest where price might stop once it breaks out. Now, let's replay the bar and see if actually price really did respect any of these previous lines. We'll just watch how it plays out. We had a little bit of a rejection here, but nothing actually that respected the line. We had a little rejection here where it bounced off with a nice weekly pin bar. But as you can see, if I now stop this, we didn't really come up to respect any of these lines. There was no suggestion based on these previous lines that price respected these levels, because if it had have done, we would have actually come up and met these lines. So what I'm trying to say is that sometimes previous market structure isn't as important as knowing the rules of a range. Now I'm just going to show you an example of this. What we would simply do is we would place our support here, which is around the 1.0500. And then we would place our resistance around here, which is the 1.14 sort of 50 region. And we can simply see how accurate range targets are by duplicating this range. Now, as you can see, this was the true target. So we would have simply known that the moment this broke out, we were coming up to this region. You could have known that almost 18 months before. Now, also with this being said, if we look at these weekly clusters, we can almost confirm this was our first touch, this was our second touch, and this was our third touch, which is the highest probability. So we could have simply just bought it off the rejection of this support. Again, at the top, we had a cluster of weekly candles here. First touch, second touch, and third touch. Again, this would have been our highest probability of selling. So we could have simply sold off this weekly candlestick, which showed a very nice rejection of, yet again, this previous resistance, which we would have had marked on the chart, from these initial 2 points, and we would have had this line charted from these initial 2 points. So because we would have had these lines plotted from these initial 2 points, as I said earlier, we never trade 1 and 2 because we need 1 and 2 to first define the structure. And again, with the bottom, we never trade 1 and 2. We're always only ever trading 3 on both sides. So we trade this as a sell and we trade this as a buy. And basically what we'd be looking is we'd potentially be looking to get out of this trade here and to get out of the trade from here. But like I said, going on the basis at the fourth touch, which would have been here, has the highest probability of breakout. This kind of proves my theory even further that when we did approach to make the full touch, what most people were expecting was a rejection. But in fact, we broke out. Now, like I said, a lot of people would have been looking left to try and figure out where we were going next once we did break out. And all of their lines that they would have placed on the chart would have actually been inaccurate because all we had to simply do was just duplicate the range. Now, this is a lot of the stuff that I use when I'm trading, is I'm using equal movements, I'm using duplication. It's very similar to a head and shoulders pattern, which I would have gone over with you guys earlier, is we would have the left shoulder like this. We would have the head that starts to create. And then the moment we came down like this, we confirm that we have our 2 touches. So what's the first thing that we do when we have 2 touches? We apply a trend line. We can already mark off the left shoulder as resistance. So therefore now what we are looking for is we're looking for an equal movement to produce the right shoulder. So therefore we duplicate this, we'd anticipate a right shoulder, and as an extra layer of confirmation, we could also fib this, and most of the time, the right shoulder would also form at the 61.8. That's another layer of confluence. So, for example, if price began to bounce again and reject this neckline, this is when we'd start thinking, okay, this is definitely starting to begin to look like a head and shoulders pattern. We now need to start anticipating the right shoulder, and then this would be the best form of entry. And then what would happen is price would then come down. Now, with regards to head and shoulders patterns, it's very similar to a range. We simply duplicate from the neck to the head. We duplicate this for our target. Now, duplication with regards to a head and shoulders pattern is always the best target. Fib extensions are kind of irrelevant when it comes to head and shoulders patterns. Most of the time I tell people, like I've said in the rules before for the Fibonacci, is that once we retrace off one of these levels, either the 786, the 618, the 50 or the 382, we would therefore be targeting 0% as our first target, minus 27, and then minus 618 if we can get that far. But as you can see, that in fact this duplication is a lot further than that. So therefore it's in our best interests to try and get the full move of this market, which is why duplication is so important. And this works equally just as well with inverse head and shoulders. And like I would have said in my previous videos, if head and shoulders comes as far as this, it's just not really a head and shoulders pattern for me because I'm really just trading off equal movements. I understand, I know a lot of people do trade head and shoulders like this, even if the right shoulder is higher than the left shoulder. But for me, it's not really a head and shoulders pattern for me. This would be an invalidation, especially if we fibbed it and we came above the 786. So that would invalidate this head and shoulders pattern for me. But I think this is why people get stopped out a lot, is because they don't understand the rules of patterns. And as you can actually see from this pattern, going back on the theory of creating the first touch and the second touch, on the top layer, this would be touch 1. This would be touch 2. And as I said before, touch 3 is the most highest probability, so therefore this would be touch 3. And again, on the bottom layer, this would be 1 and 2. Okay, so this is where we start using the numbers theory almost to trade. So your next opportunity with a head and shoulders pattern, if you missed the right shoulder and you failed to see this happening and you failed to anticipate the right shoulder, what you would therefore be looking for is a break of the neckline. Okay, now we don't ever trade just breaks. We have to wait for a retest. So therefore, we'd be looking for something like price to do this. Come back up to retest the 38.2. And then we would still be targeting the duplication. Okay, so although we have our fib level targets, our extensions that we'd be aiming for, we would still be targeting the duplication. So that's still very relevant, even if we're getting on the retest, because we know that it's very likely that price is going to come down. And normally with a retest, it actually does line up with the minus 618. So that's something to bear in mind with market patterns. I'm just almost showing you another example here of duplication. It's not very relevant to this current chart. So let's go back to the chart. So the first thing that I do when I'm on a weekly chart is I am looking for, once I've decided my bias, in which case this is bearish, so I'm only looking for excuses to sell it. Once I've decided my bias in a higher time frame, I then have to find some key levels around current price action. Okay, so again, I see a lot of traders do things like this, where they place like a line here, or they begin to place lines here. These kind of lines are just not relevant right now. We're so far away from it, it's just not necessary to have it on our charts. So the first thing I do on a weekly is I flip over to the line chart, and I'm finding lines which are relevant to current price and have the most strength. So on the weekly time frame, I'm not just looking for 1, 2, and 3 touches. I'm looking for the most touches as possible to prove the strength of this line. Okay, so in this example, I'd be looking for price to mark points around this price. So this seems quite an obvious level for me, which would be around the sort of 114 level. So I'd round these numbers off if possible, because as I've explained before, round numbers are something that the humans are naturally gravitate towards. You know, for example, the pound to the dollar, people generally sort of buy off 130, they buy off 135. So when we approach these kind of round numbers, you know, we kind of move towards them. We see a lot more of a reaction towards round numbers. So that's my resistance now plotted as it's above current price action. The next level that I'd be looking to plot on this particular chart would obviously be either around current price or below it. So in this scenario, I'd probably go for something like this, which for me, once rounded up, would be around the 112. So as you can see, we're now creating a support and a resistance around current price. Now, you could probably go a little bit further with this, and you can actually plot 2 more lines here. So therefore, this would probably be one here, which would maybe be around the 110. And then you could probably even plot maybe one sort of here, which would be around the 116. Okay, so you can see how well price has respected these levels. But the thing is that these levels right now are kind of irrelevant. They're irrelevant until we break these levels. So the idea is to try and keep our charts as clean as possible to help not confuse us too much. Because, you know, I hear a lot with traders where traders say, trade between the zones, just simply buy if it bounces off one line, sell it off the next line. But the problem is that if we've got too many lines on the chart, we start beginning to get confused. Which line means what? Which line has the most significance? And, you know, where that line has come from. So until we break above this line, that's when this line may become relevant as our next potential resistance on the weekly time frame. And again, until we break this is when this becomes irrelevant. So for the time being, I think it's best if we just delete this. And then what I'm going to do is I'm just going to mark this up so we know that when we begin to scale down what this actually means. So therefore, I would just write resistance, and I'll just put this at 114. And then I would write support. It's entirely up to you whether you want to write weekly or daily support, etc. But I'm just going to keep it nice and clean. So then I would be going back to my candlestick patterns. And I would be looking to see if actually price has respected these levels. So we can see we had a reaction here. Again, we're not really too fussed about this. We had a reaction here and multiple reactions around this region. And we had this reaction here when we broke out and here. And again, with the 112, we had multiple reactions where prices respected these levels. So I'm happy with those levels. So right now I've confirmed two levels on my chart, a support and a resistance around current price. And I've also confirmed that I am bearish. So therefore, I'm only looking for reasons to sell this particular pair. So let's just write this as a daily reminder. Bearish bias. So we don't get too confused when we begin to see a little bit of bullish price action. So the next thing I would do, because I want to focus on just this part of the chart, is I'll now scale down on the daily. Now, as you can see on the daily, we are also forming lower highs and lower lows, which also suggests our bearish bias. Now, we can see here, if we look left, that this was our most recent higher low when we were in the bullish run. Okay, so we had this massive sell-off. We've already cleared up why price came exactly to here. So we had this huge sell-off, and everything really changed for this particular pair when we created this new lower low. So this changed the entire sequence. I mean, we would have seen anyway that it was bearish because we had this huge sell-off of around sort of 700 pips maybe. So when price stops, as I've said in my previous videos, the first thing we have to do the moment price stops is we have to draw a fib on price action. So in this scenario, we'd simply draw a fib from here to here. Now, if price fails to come up and touch any of these fibs, the fib is invalid, so therefore you would expect for price to continue, and then you'd have to simply keep moving your fib until price eventually hit one of these zones. Now, like I said to you before in the rules before with the Fibonacci levels, generally what happens is when we get a huge sell-off like this, and what we've witnessed here, which is a 700 pip sell-off, which is a big sell-off for this particular pair, 9 times out of 10, it's very likely that you're only really going to come up to the 38.2, and then it's going to be a continuation. Okay, and that's exactly what we did. We came out and we tapped the 38.2. And in addition to that, we also tapped our daily 50 EMA, which is a very, very strong confluence. We knew on this occasion that it was very unlikely that we were going to come to the 50, the 61.8, or the 78.6. Why did we know that? Well, it's simple. We also had this very strong, powerful moving average that was just capping price. So therefore, if we actually broke above this daily, that would actually show that we could potentially be on a reversal and continue our bullish run. But because we created this, and then we had this, we could quite clearly see that price on this occasion was only going to go as far as 38.2. Okay, so now that this has happened, this is currently now our first lower low. This is our first lower low. So now after a lower low, we're now expecting a new lower high, which is what happened here. Now, obviously, we can't confirm anything yet until we get at least two of these both sides, okay? So we're not so sure yet exactly what's happening until we begin to see at least two of these and at least two of these. Now, again, we wouldn't be trading this right now, simply because we're waiting for more confirmation. So when price began to go down and move further down to create this lower low, we could then simply anticipate the fact that price was likely to create a new lower high, which is then what happened here. Now, once this happened, we could quite clearly see that because we have two both sides, we're now looking for a third. This is what we're anticipating, and this is now what we're waiting for. We know this because we have a bearish bias. Price has confirmed this move for us. So now we're basically waiting for a new lower low. So price collapsed, and it did exactly what we thought it would, and it would create a new lower low. So we're very much in a bearish sequence right now. Now, what I want to do is I want to block off price so that we don't start getting tricked. So I'm just going to simply basically block off this. Okay? So let's just focus on this part of price right now. Now, because we know that we're creating these lower lows and these lower highs, obviously we're now anticipating a new lower high. So we're thinking it's going to maybe be around this kind of region here, because it has to be lower than this. So as long as price stays below this point, we are still very much bearish. Now, we don't know whether this is our new lower high. You know, price could come a lot further. It could come up to here maybe, something like that. And what a lot of retail traders would have been doing is, because this looks quite bullish, they would have been drawing a trend line on this, like that. Okay, so therefore a lot of traders would have basically been waiting for price to come back down, simply bounce and come up to create a new higher high, because they're only focused on this part of price action. But we know, because we're looking to the left, that we're only anticipating a new lower high because we're bearish. So to confirm that this is indeed the new lower high, we're not so sure just yet. We don't know. We have to see further price action. So let me just see what happens. Let's just play this and see what happened. So we came down to the trend line, where most retail traders thought to buy. But then what happened is we broke it. We broke this trend line. Now, when we broke this trend line and then we bounced off it, people still thought, okay, great, we're still going to come up. So therefore, a lot of people were still buying this. Now, the first thing that we can do once price stops is we can stick a fib on it. So this is what we can do. We can stick a fib this way. We're going this way because we have a bearish bias. So we know that as long as price, like I've shown you in the rules before, as long as price stays below 78.6 and doesn't break above and close above, we can confirm this is our new lower high. So this is our region where it becomes invalidated. So as I said in the previous videos, the 78.6, if it's a daily fib, we would need a daily close above the 78.6. If it's a 4-hour fib, we would need a 4-hour close above the 78.6. The 78.6 is the last point where we would basically say, nope, this isn't our new lower high, and we'd therefore be expecting price to come back up. And like I said, as long as it didn't break this region here, we would still be anticipating a new lower high. So what could have happened is price could have bounced from here, come up to here, and then this might be our new lower high. But we're thinking this one is going to be the one. So let's see what price did next and see if it did respect the 78.6. Great. So as you can see, price did respect the 78.6. So that has now confirmed to us that this is our new lower high. Okay. So again, like I said to you before, you guys, the moment we have two touches, we can apply a trend line. Now in this current scenario, we have two options to draw this trend line. We can go from here to here, or we can go from here and try and find the most points. So in this case, this trend line suits much better as opposed to here. So this would be our favoured trend line. So now because we've got 1 and 2, what are we now waiting for? We're waiting for number 3. But we can't figure out first where the number 3 is going to be until price begins to come down here and stop. Okay, we have to wait for price to come down and stop to enable us to put a fib on it to then anticipate where our third touch is going to be. And this is where we start predicting where price action is going to go next. So what I'm now going to do is I'm going to scale down to the 4-hour. And I'm going to do a bar replay so that you can't see price from here. Okay, so we have our two touches. We can confirm that we didn't break above the 78.6. Because we have our two touches, we can now draw our trend line, like so. And what we can begin to do is we can mark this chart up so we understand what's going on. So we have a lower high, which from this sequence is lower high number 1. Let me just make this text a little bit smaller. Lower high number 1. We have lower high number 2. And then we basically have 2 secs. We have lower low number 1. And then we have lower low number 2. So we are simply waiting now for a new lower low, which would be our lower low number 3. And then we're waiting for our new lower high number 3. So what we now have to do is we have to patiently wait for price to come down. Now, what we're looking for is we're looking for price to break this lower low. Now, we know that we're within a bearish sequence because we've got these 2 points. So what we are now waiting for is price to move. So let's just play the bar. Okay, so price has begun to stop now and it's created this new lower low. I'm actually going to remove this and I'm going to call this one lower low 1. Because that makes a lot more sense. And price has now stopped. So the simple thing that we do is we have to wait for price to confirm that we have stopped. Now, what a lot of people would have done is they would have put their fib from here to here. We would have seen that we didn't hit any kind of retracement, so therefore we would have known that once price started to roll over, we'd have had to move our fib. We would have then moved it from here to here. It still failed to come up and touch any fibs, so we would have to keep adjusting until we confirm that price has indeed stopped. Now, once we have this fib placed, we can quite clearly start to begin to imagine where our lower high number 3 will be. This is where we can start anticipating our third touch. Let me just go back to the daily quickly. So I believe this trend line has potentially moved slightly. Go back to the 4 hour. We will do our bar replay. So now price has stopped. As I said, we've kept moving our fib until it makes sense. Price has now stopped. We've had this this bullish candle after this rejection to suggest now that we have indeed formed a new lower low number 2. Lower low 2. So we apply our fib and now we can begin to anticipate where we think price might go to. Now, when we're looking at this, it's unlikely price is going to go to 38.2. Because there's no reasons for it to go to 38.2. There's no confidences really around here. Yes, we have the 38.2, which is a confidence in itself, but there's no reason for it to come here because there's nothing else really around it. We also know that we're probably not going to come to the 50 because, again, there's nothing really around here to suggest the price is going to come. But we do know that price is very likely to come here because this fib lines up with multiple other areas of confidences, such as the 114 weekly resistance. It lines up with potentially the third touch of the descending trend line. We've got the 618, we've got the round psychological number of 114. We've got lots of reasons to suggest now that we are anticipating price to come up to this level for a sell. So we know that this is very likely because we've got multiple levels of confidence to say so. So all we have to do now is simply just wait. So let's just play this out and see what happens. So we're anticipating price to come up to this point. Now, when price begins to do this, and we start to see price beginning to approach our favoured area of interest, we can start doing other things. For example, we can draw a counter trend line like this, okay, which almost supports price. It's a counter trend line because it is against the trend. And we can also see there is potentially a market pattern here as well. Something like this. So let's carry on watching price. Price is currently being squeezed, and the rising wedge pattern is a bearish pattern because price is being squeezed up towards our favourite area of interest. And basically what we're now looking for is we're looking for price to eventually either break above or below this. Now, we know that it's very likely that price is going to break below this wedge. But we're not just using the wedge just as our only layer of confidence, we're just using it as an extra layer of confidence. It's not a make or break for us. But we can see that price is very respecting this wedge very well. And we can see that then price begins to break out of the wedge. We've now broken out, and we're now coming down to target. Just as we thought. Because as I said before, the third touch is the highest probability, and this is where we would be executing. Now let's just pause this just for a second and go back and see what actually really happened here. Okay, so let's go back to this and let's see what really happened. So let's do a bar replay and just cancel out this. Okay, so as I said, price was coming up and approaching our favoured area of interest. Now, I just want to scale down for a second because we have to remember that when we start to approach our favoured area of interest, we have to scale down to find the best entry. So what I'm going to do is I'm actually going to go down the 1 hour on this particular chart. And I'm going to do a bar replay from here. Okay, so we're within our rising wedge. We're beginning to approach our favoured area of interest, which is the 618, the 114 resistance. The third touch of our ascending trend lines, we're anticipating a lower high number 3, which would be our execution point. Now, I want to talk about what a lot of retail traders would have done in this scenario. Is let's just make this nice and slow. Is because they're impatient, they would have just got straight in off this point here. Okay? Because they're impatient, they would have just got straight off this point here. Because they would have known that this is a nice level, 114 is a lovely level. So therefore what they would have done is they would have just gone short after these two candlesticks. They would have gone short, say for example here. And a lot of retail traders would have put their stops just above the 78.6. Okay, because we know that the 786 is the last point of invalidation. And that's where most people put their stops. Now for targets, because we know that we're anticipating a new lower low, like I've taught you guys, the first target would be 0%. And then normally you'd aim to go for the minus 27%. But we're well aware that because we've already plotted our levels on the weekly, that we have something that's very significant that's in the way between these two levels. And that's the 112. So therefore the safest bet would be to actually get out of this trade at the 112. Now this trade, based on a retail trader's perspective, would have been a 1 to 2.8. So let's just draw that out so we remember this. So it would have been a 1 to 2.8, which isn't a bad trade, because as I've taught you guys in the risk management videos, we're always going for a minimum of 1 to 2. But if we can help it, we'd much rather have a much tighter stop than 69 pips. We'd rather have at least half that, really. So like I've explained in the other videos, what we're really waiting for on the smaller time frames, which most of the time you can't see on a 4 hour. This is why it really is quite pointless to wait for a 4 hour candle closure. We've already identified that this area is of interest. We've already identified that we've got multiple layers of confidences to sell this from a higher time frame. So what would be the point in waiting for a 4 hour close? It's just not necessary. We already know we've got so many reasons to sell this. So we don't need to wait for a 4-hour close. We just need to scale down to the 1 hour, the 15-minute to find a really, really great entry. So if I can help it, I never use the 78.6 for my stop levels like most other people do. What I do is I simply wait for my first tap of my favorite region, which is this region here. Once I've got my first tap, I will then wait patiently for the second tap, and I'll use the first tap as my benchmark for stop losses. So let's just see what happened here. So we came down, and then we came up, and then we created this second tap. So therefore, I would have been patiently waiting for my second tap. This would be my entry on this high test candle, which yet again has shown me that we've once again rejected this same level. So therefore, my entry would be on the close of this candlestick. And my stop loss, because I'm using this as my benchmark for stops, I would simply allow enough space for my trade to breathe. And I would put my stop loss always at least a minimum of 30 pips above. Now, as you can see, that's way, way below the 78.6. As opposed to having a 65 pip stop loss up here, we've now reduced our stop and we've made our stop at only 30 pips. And by being patient and waiting for this second tap, as opposed to just getting straight in off here, we've double confirmed now that actually this is a very strong level. Okay? So therefore, again, my targets would be, I'd have to zoom out. My targets for this trade again would be, sorry, bear with me just a second. My targets would yet again be the 0%, where I would then take some profit off the table. And then again, I would be also targeting the 112 because I'm aware that this is a very key level in between the 0 and the minus 27%. So that makes my trade a 1 to 6.5. Which is so much better than a 1 to 2.8. Simply because we've waited for that second tap. We've used the first tap as benchmark for stops. We've placed 30 pips above to allow enough breathing room. And because of that, we've got the same targets as the previous person, but we've got much better stops, which allows for us to have a much better reward. So now let's scale back into the 1 hour. Okay, let's go back a minute to current price. And let's do a bar replay once again. So therefore, that would have been my entry straight off there. That would have been my entry, my second tap, 1 tap, 2 tap. Now let's see what happened next with price. So we came up and we touched it for yet again the third time. So we just watch how price plays out. And basically what we would have witnessed here was price really just popping up to take out people's stop losses. Okay, now the reason why this happened was because a lot of people who did get in here or even here would have not allowed their trade enough space to breathe. Now, most retail traders would have put their stops above here, so therefore in which case they'd be safe. But this is more for the people who would have put their stop loss only sort of 20 pips above the 114 zone. Okay, or even putting it at 114.25. A lot of people like going off those kind of numbers, the quarterly numbers, in which case you would have obviously been stopped out. And the market makers know this. They know where your stops are. So therefore it's in their best interest to drive price up and stop you out. So if you were fortunate enough and you'd actually managed to get in on this spike, which the experienced trader would have done, then good for you, no worries at all. But most people would have got in here on this first touch out of being impatient. I would have got in on the second touch, used this as a benchmark for stops, and price would have come up. I wouldn't have been at break even at this point. Price came up. It came into my stop, in which case I would have been about sort of 15 pips in drawdown, maybe a little bit more, 20 pips. And then price returned again. Now, if this was the trade, and say for example we missed this opportunity, and this opportunity, where would be our next opportunity to get in on this particular trade? Now, the next opportunity to get in on this would simply be a break of this counter trend line and a retest. Okay, so if we'd missed those three opportunities, we'd now have to patiently wait for price to break this counter trend line and hope that it does break the counter trend line and also that it retests. Now we have to bear in mind that the breaks and the retests on the larger time frames are very difficult to see. So therefore we've always got to make sure that we're scaled down in price so that we don't miss anything. We already know that this is an area of interest, so there should be absolutely no reason at all why we're looking at the 4-hour time frame or even the daily. We should only be looking at the hourly right now because this zone is an area of interest. So let's watch how price played out. Okay, so we've now confirmed that we've broken the counter trend line. And now we're hoping for a retest. Is the retest going to happen? Let's see what happens. Okay, so at this point, we've now got our retest. Okay, we've retested the counter trend line, so this is another great entry. In addition to that, we've also retested the 114, the main larger 618 fib. So we can quite clearly see that this hourly rejection, if we wait for this hourly rejection, we could just come straight off this. But there's another layer of confidence here as well. And that's if we can do a fib within a fib. Okay, now we can, like I've said to you before, the 786 is the last point of invalidation. So therefore we would have had to wait for this hourly to actually officially close before confirming that price has indeed respected the counter trend line and it also has respected the 786. Okay, so that's quite obvious. So in which case we would have placed a short entry if we'd missed these first 3 entries off this hourly close and put our stops again 30 pips above. Like so. Now it's unnecessary to put your stop above here because we have already broken this counter trend line. We've already respected the 114 level multiple times. So this is a very safe place to put your stop loss. Now again, we'd have to now delete this fib within a fib because the target regions for this are irrelevant. They're very small targets. And obviously our picture for us is focusing on the main target, which is obviously, like I said to you before, the 0%, which is a lot further down, which is here. This would be where we would take our first amount of profit off, and then obviously our second target in this case would be the 112. Okay, because we've done our homework and we've already put this 112 support on from years ago. So these levels have been plotted now on our chart for years. So they're very strong levels. But obviously if this target wasn't here, this 112, then in most examples we'd be aiming to go for the minus 27%. But I always suggest for people to take profit off the 0%, even if it's 50% profit or whatever. So in this particular trade, this would be a 1 to 6.2. So it's still equally just as good as a trade. We had a 1 to 6.5, a 1 to 1.28, 2.8, sorry. And then this is now a 1 to 6.2. So it's similar to this entry we had here. So we didn't really miss much. And that's how you would trade this. Now, with regards to actually exiting out of this market, we're fully aware that we've got the 112 level, so that would be an obvious level for us to take profit. But let's say, for example, we're those kind of traders that like to squeeze as much as possible out of the market. So let's just do a bar replay and actually remove this this part of price action. Okay, so we're in profit. Everything's going really great. We're really happy. Everything's going perfectly. And we're now anticipating that we're going to create a new lower low. We're not sure where yet. Maybe around the 112 or something like that. That makes sense to us. This would be our lower low number 3. Now let's say, for example, we didn't have the 112 in play. Because I want to teach you guys not just how to enter the market, but I also want to let you know when to exit. What are the things that you need to be looking for to know when to exit this market? Because, you know, a lot of people have problems holding their trades. And if we don't have realistic targets in mind, and we don't know how to quickly get out of the trade if it starts turning against us, we want to know where the best place is. So we're currently on the 4-hour time frame. We're watching price play out and maintaining our profit. So we drop like this, okay? We form this candle and everything's looking great. Everything's looking like we're probably going to hit the minus 27%. Because like I said, once we break the 0%, it's very likely we're going to then go to the minus 27%. But actually, in this current scenario, what happened was we stopped. And the actual trade itself began to almost turn back on us. So in this case, we would have panicked and we probably would have closed our position out, maybe like here, and we would have missed all these potential sort of 35 extra pips that we could have got. This is what we needed to know. Now, there's a specific reason why price stopped at the 1.11 sort of 75 region. Now, as I said to you guys before, the first thing that we can do when we get 2 touches of a trend line, 2 touches of price action, is we can draw a trend line. So therefore, we would have had this trend line plotted. Like so. We would have known that was already there, and we would have known that this was our area of interest here. Before this even happened, sorry, bear with me just a sec. Before this even happened, we would have already known this was an area of interest. Somewhere around here would have been an area of interest because we had this trend line already plotted. So this would have been another confluence and confirmation for us to actually get out of this trade. But there was another one as well. I'm just going to show you that in just a sec. So let's just replay price once again. So price dropped, and it respected this part of the trend line perfectly. Now this suddenly then created our new lower low number 3, which again, even though this would be a counter trend trade, this is our third touch, which is the highest probability of execution. So we can actually trade this, but we're looking for a bit more confirmation. We don't want to just use a trend line for our confluence to place a trade. We want a few more confluences. So what we would have had to do is, not just because of this trend line bounce, but there was another reason why we would have known to get out of this trade. So let me go down to the 1 hour. I'm going to have to do a bar replay again because it seems that when I flick through these time zones, it doesn't allow me to keep this bar on. So let's get rid of that. Okay, so we came down to touch the trend line, right? We can see this here. Now, the other obvious sign to get out of this trade would have been this bullish engulfing candlestick, okay, which engulfed the previous candle. Okay, so therefore, the moment we saw that, we would have known to scale down on the 1 hour because we would have scouted out already that this was our area of interest because of the trend line. So when price began to approach the trend line, we would have been aware of that. So therefore, we would have watched how price reacted to the trend line. And therefore, when we saw the bullish engulfing candlestick, this is where we would have cut our trade short if we hadn't have had the 112 level in play. Because not everybody's always going to have these key levels in play. So this would have been your first signal to cut this trade. So therefore it would have been a 190 pip trade, which is a great trade. Now, because we've got multiple layers of confluences here too, we've got the third touch, we've got the descending trend line here, which is protecting price. We've got a bullish engulfing candlestick, and obviously we've also got our 112 level region around sort of here, right? So we've got the 112 around here. So we know that this area here is generally quite a nice high level of confluence to place a long trade. Third touch is the highest probability, 80% of continuation. So therefore, what we could have basically done on this is we could have gone long straight off this bullish engulfing candlestick. Now, the reason why we could have gone long off this candlestick is simply because on the way down, there was no bullish candlesticks whatsoever on the way down to suggest that price was going to stop. So we had no reason to close this trade. We knew that we were anticipating a new lower low. When this happened, we did create that new lower low. That was our confirmed lower low because of this bullish engulfing candlestick and the bounce from the trend line. So we could have simply placed a long position. And again, put our stops 30 pips below. Okay, so with regards to... Sorry, let me just redo this. $30 pips below. Now, with regards to our targets, it's very simple. All we have to do is, let me zoom back out, and I'm going to have to do another bar replay. With regards to our targets, because price has stopped, what's the first thing that we do when price stops? We put a fib on it. So let's just delete this fib, clean things up a little bit. We can simply attach a fib from here to here. And we can begin to start to guess where our target is going to be. Now, because this is a counter trend trade and we're actually trading against the trend, I'm never too fussed when people turn around to me and say, I've got a 1 to 2 risk to reward on a counter trend trade, because anything that you can get from a counter trend trade is great, because we are trading against the trend. It's a very aggressive trade, and any profit's better than none. Now, if a student was to turn around to me and say, I only got a 1 to 2 trading with the trend with this amount of confidences, that would be very frustrating, because it's quite obvious this is a quite obvious sell. But with this one, it's a little bit more dangerous. So I could understand if people would want to take profit at the 38.2. It's still a 1 to 2.5. But for me personally, because I've got all these confidences in this descending trend line, I'm now anticipating a new lower low on the 4. Now, you and I both know that we don't trade the lower high number 4, but I'm anticipating to be around this kind of area. I know that because it's not going to go as far as the 78.6, simply because it's above the descending trend line. So that's out of the question, but it has got a chance to come to these 3. So it's entirely up to you really what you want to get out from this. But because there is more confidences around this area, I would actually be targeting the 618 on this particular occasion. So that provides me yet again with another almost sort of 1 to 4.5, something like that. So let's just play out price and see what happened. So price would have come up at this point. We tapped the 38.2, so we knew this was a valid fib. Price continued, we tapped the 50. Price then made its way up to 618, and this is where we would have then obviously got out of the trade. Just out of, we wouldn't want greed or anything like that getting in the way. So this would have been our secondary trade. Now, as I said to you before, when we start approaching the fourth touch of a trend line and the fourth swing of this sequence, we would have not traded this trade, because it's a 50-50 chance that we're going to actually continue and come back down. Now, a lot of people would have traded this, and actually a lot of people probably would have sold off this 618, or they would have sold off this kind of level around here. And then yet again, they'd be targeting further down to get a new lower low number 4. But it's not a trade for us, because we only trade third touches. So if I just kind of prove this to you, how the chance is, slim. As we can see that people did sell off the 618, it did begin to retrace, but then unfortunately it came back up. People would have put their stops above the 78.6, which is a nice place to put your stops, it's above the trend line. They still wouldn't have been stopped out. And then basically price came up. We were still safe, and then bang, everybody would have got stopped out. Okay, on this big move upwards. Okay, so a lot of people would have traded the fourth touch. The reason why a lot of people trade the fourth touch is because they believe that to create a trend line, you need 3 touches, and therefore you trade the fourth. That couldn't be further from the truth. It's in fact, you need 2 touches of a descending trend line, and actually we execute always off the third of either side. And when it gets to the fourth touch, in fact, our probability is half, and it's a high probability that it's going to break. Now, in this scenario, we did break, and that's a very fine bit of chart work to show you why we don't trade the fourth touch. So I hope that has been helpful to you guys. I just want to confirm the confidence here that we have for the third touch, because we never just want to trade off the third touch. We actually want to always have multiple levels of confidences. So for this particular trade, we had the 618%, which lines lines up with our potential third touch. It also lines up with our 114 weekly round level, and we could also from the counter trend line, which we could place after the few touches at the bottom, this was also a rising wedge, which was squeezing price towards our favoured area of interest. So we had multiple levels of layers of confidences to confirm that this was indeed a sell. And we would have known this the moment this happened. The moment this happened and stopped, we could have placed a fib. The fib region lined up with this level here. Then we had multiple confidences to sell this. I've shown you the best way of selling this is to simply wait for the first touch getting on the second. Use the first touch as the benchmarks for stops. And this is how we would have placed this trade, as opposed to having our stops at a 65 pip stop, which is what a lot of people do, which It's not a bad thing to do. Just it means that you've got a less chance of getting stocked out. But the only problem is with that is that we're getting a lot less of reward. We're getting a 1 to 2.5, 1 to 2.8, instead of getting potentially a 1 to 6, 1 to 6.5. So remember, once you've scouted out your area of interest, which would be this, we simply have to go down to the smaller time frames and look for that double tap. 1 tap, 2 tap, sell it. 30 pips above, give it space to breathe. And that would be your first trade, and your second trade would obviously be down here, which we could have anticipated because we had 1 touch, 2 touch, apply the trend line. We knew price was going to come down to here because we had multiple layers of confluence. We had the 112, we had this trend line. So therefore we know that this was already an area of interest. So we should have been on the smaller time frames when it was approaching this level. We would have seen the 1 hour bullish engulfing candlestick, and that would have been an entry for us. And then again, we would have just placed the stop loss 30 pips below. And we would have been again targeting the 618 because that lines up with the fib. So I hope that all makes sense to you guys about how to almost go from a blank chart on the weekly to then finding your lower lows and your lower highs, connecting all of those up, how to anticipate price action, and how to use layers of confluence to confirm that. So on our next video, we'll be breaking down USD CAD, Euro NZD, gold, and a few other pairs where I can show you market patterns and how to use better layers of confluence.